Hi, this is Brian Zeek, founder of ServSafe Financial Group. Uh, in this video, we're going to be talking about long-term care. We're going to cover different aspects of it. What is long-term care? Some of the things you need to be thinking about around long-term care. We're going to discuss a little bit different ways to cover the costs, and we're also going to be talking about the cost of care. And so we'll get into some statistics and whatnot. Because I think this is a really, really important issue. Everybody I work with, whether it be just a financial plan, retirement plan, it might be in a business setting, as there's some great benefits for business owners as far as the taxation of this vehicle, of policies. Let me put it that way. So there's some pretty neat little deal. Like I said, tax benefits, even for business owners. I think it's a great way to get care if you can get your long-term care policy, if you can, especially if you're a small business owner. One of my, I got into this a long time ago, the long-term care arena. I wanted to add it as far as an expertise into my trainings, because I saw what an issue it was and how costly it can be, meeting people that were in this situation, seeing people that were in this situation. And as I started digging into the costs, I knew it wasn't something we could completely ignore. And you don't want to just hope. And I've had a lot of people make commentary on, I don't, but you never say never. I mean, because we know 50% of people are going to need care, and 70% with couples, there's a 70% chance somebody in a couple is going to need care of some sort. And one of my other issues is my industry, I don't think talks about this really well, or even we wrote a book called "There's More to Financial Planning Than Financial Planning," and and the reason we wrote that book is because what we always run into is, people have a lot of people out there, and I say most people out there is what they have as an investment person, right? You go to an Edward Jones, they're pretty much just paying attention to investments. You go to a Schwab, they're pretty much paying attention to investments, and they're not going to be expert in this, because I've seen is they either say, you got plenty of money to handle this, which I'm here to say that maybe you don't, but I'm also here to I think that in a lot of ways and sometimes they'll sell kind of an undersized policy. Now my cynical nature says, maybe they probably want to just keep all the money they can under assets rather than put it inside some insurance policy. Or maybe they just don't understand the risk. I don't know. I don't interview all these people and ask them this question. But I do think it's really, really important, and it should be talked about. If you're working with somebody that hasn't brought this up to you, you need to question what type of advisor you're working with. And I feel strongly about that, because along with this, you should be thinking about taxes, and you need to be worried about inflation, market corrections, and long-term care is obviously a big one. So let's dive in a little bit here. So first of all, let's talk about what is long-term care. How do you fall into the long-term category where you now qualify or need long-term care, this type of thing. And another thing I want to point out is a lot of people think Medicare will cover this, and it does not. There's a few little things that'll cover, a little bit of respite care, and there's a few things like that. You might get a little bit of coverage from Medicare, but it's very minor. So, all right, here's our activities of daily living. There's basically 6 of them. Eating. Can your loved one feed themselves? Right. In other words, are they still capable of actually feeding themselves? Number 2, bathing and hygiene. Or is when you're seeing your loved one, are they clean? Do they bathe regularly? And dental hygiene. It's kind of funny. I was at I basically went to a new dentist, and I was actually talking to a hygienist, and it turned out that she was. But you can talk to a hygienist when you're working on your teeth. But she was telling me how she had gotten licensed to go into homes and clean the people that were in this situation, their teeth. And it rung a bell with me because I know bad dental hygiene helps lead to it's one of the things that will help lead to Alzheimer's and heart disease and things like this. So taking care of your, especially in this facility, you want to make sure people are getting good hygiene. Dressing. Can they actually dress themselves? Can they get dressed themselves and make acceptable clothing decisions? Grooming. Are they combing their hair? Are they cleaning their nails? Are they doing all this sort of stuff? Mobility. Mobility is often judged on whether you can move around without assistance of a wheelchair, walker. In other words, can they get yourself out of bed? Can you get on the toilet yourself? Can you walk stairs? All this sort of stuff would fall around. That's what I was saying earlier. If you ever, if you needed a cane now, you're not going to get a long-term care policy because you had already triggered one of the ADLs. Toileting, in other words, are you in control of your bowels, your bladder movement? Can they go to the bathroom without physical assistance? So these are basically your 6 ADLs. Now, again, to trigger in other words, say if you had a policy, if you lost 2 of these, you would now qualify as needing long-term care. Now, we see that some people, a huge majority of people in long-term care facilities are suffering from Alzheimer's and dementia, which would automatically you'd start losing these and eventually all of them. So diagnosis of Alzheimer's is gonna trigger it as well. Because you see in the corner there with the picture, handling your meds would kind of be in these in this arena as well. Okay, let's talk a little bit about the cost of care. We've discussed a little bit about what is long-term care, fact that the state covers a lot of these costs, because the state is a majority payer for long-term care in this country. Back to my commentary, but here's the annual cost in California. Now, I'm showing California because it is the most populated state. I happen to work in California. This is my home state, and not that I don't do work in other states. I don't help people in other states, but this is primarily where I work. So here's the cost of homemaker services. This is when they're coming in, they're helping you around the house. They're making sure you're okay. They're making sure you get fed, all that kind of stuff. They're basically kind of coming in and taking care of things around the house and you as well. And that would be, you're seeing today, which is 2018, as I did this video, $60,000 a year. In 10 years, you're probably looking at around almost $80,000 a year. Then you got home health aid, and that's somebody that's actually coming in or making sure you're getting your meds and all this sort of stuff. And it kind of falls in a very kind of similar category. And you see the costs are very similar as well. So then you have adult daycare. Now, adult daycare is where your loved one might be there. You might take your loved one there during the day, while you may be working, or just for work, just for rest. It's just some place where they'll take care of people in this situation during the day. And you're saying that the annual cost on that is $20,000 a year. And now keep in mind, there might be a situation where you still may have other costs, but this is only your cost for the during the day. You may have some additional costs at night even. But you're seeing 20 and then 27. Then you have assisted living facility. Now, assisted living facility, it's just exactly what it sounds like. They're assisting you. This is not true where you've lost 2 ADLs. You might be able to go down to dinner by yourself. There may be a lot of things. You still might be mobile, but they are making sure you're okay. It's the kind of the more traditional old age home sort of thing, so to speak. But it's not the constant care that you would see if you say at Alzheimer's or whatever. Now, this is more your constant care, nursing home care. This is where you're actually in a nursing home where you probably lost the ability to really take care of yourself, and this is more full-time care. A semi-private room in a nursing home, you're looking at $100,000 a year in California, or $134,000, or almost $135,000. Just 10 years from now, what we're probably looking at. So, and that's a semi-private room. A private room obviously would be more, 117, 158. So it definitely goes up, and it will. It has been for a long time. Now that's your costs in California. Now your costs in California are going to vary. It's a pretty big state, and there's some big swings in demographics in California. So different areas are going to be different costs. So this is on average, because you can actually, there's some good websites and things that you can go to, and we look this up for people all the time, is what would the cost be here, there, or whatever. But this is on average. Let's take a look at the national average, right? So you're seeing those same homemaker and home health care services, 48 and 50,000. And you're looking at the adult daycare, 18, assisted living facility is 48, a semi-private nursing home, a room in a nursing home is 89, and a private room nursing home is 100,000. So as you see, California is more expensive, but it's not even the most expensive, and it's not even that close to being the most expensive. Like Alaska, Hawaii are much more expensive than California, and there's a couple other states that tend to be a little bit higher than California. And again, that's mostly because of the diversity of the state, but it is more than the national average. So there's your cost. Okay, now how do we cover those costs, right? Now, one thing you want to remember is, let's do some math here, right? So say, how long will your money last if you end up, because we know this can come on suddenly. And if you haven't planned for this, this could be a bit of an issue, right? And say you have liquid assets of $600,000, right? So say you're getting 5% return on your investment, and your current annual income needs, in other words, your regular lifestyle expenses, might be, insurances, mortgage, whatever the case may be, what costs you to basically live your life. And now you have annual extended care costs. Say you have one of a couple that end up needing care. And you see 60,000 is really, as you saw by the numbers, is not a really high number. It's kind of probably more in the low end. And if you apply a 3% inflation rate, your liquid assets are going to last about 4.6 years in that case. So again, plan. Okay, what is the cost of long-term care insurance? We know that, if you look at the cost of long-term care insurance, you're seeing, let's look at a couple, male and female, because that is the most, and let me say this, insurance companies they don't care if you're male, female, female, whatever the case may be, but we want to show an average because there is a difference between the cost for a male and a female, and depending on the age too. and they do underwriting. So these are kind of average cost, estimated cost. So say you're 53 and 50 and you're getting ready to buy long-term care policies. Let's say you're trying to get coverage of $150 a day. Now, as you're seeing that number, right? If you do the math, you're seeing that that's if you end up in a a nursing home, that's probably not going to, a full-time nursing home, that's not going to cover it, but it's going to go a long way to helping you. But this is the average size policy we tend to see is $150 per day. Now, on that, you apply a benefit multiplier. Now, the benefit multiplier, this is very common too. We try to get them out to 5 years if we can. I personally have a lifetime policy, but you can't get it anymore. I bought it a while back. But let's say you have this, right? So that means your total benefit would be $164,250. So what that means is $150 a day. If you spend $150 a day, you're going to spend $164,250 in 3 years. Now, if you only spend $100 a day, obviously that's going to last longer because it's more of a bucket. And one other point here is what I want to point out is that some policies allowed for what's called shared care, where if say a couple like this bought a policy, right? And let's say they ran out of their benefit, they could actually dip into the other person's benefit. The other thing to note is if somebody's 53 years, I'd always want to apply a inflation protection on this, so that benefit would go up every year, a certain percent, or it could be tied to a CPI or whatever. So again, this is more of a bucket money as opposed to just 3 years of benefit. Because typically when you have $150 a day, that's all you're going to get per day. That's the maximum you'll get. Okay, and so we're seeing the estimated annual premium for this. For a male, it'd be $1,678. For the female, $1,667. Now notice that at this age, a female's a little bit cheaper. And I'll say this, more females do need long-term care than males. That's just statistically speaking, because another thing, they tend to live longer too. So, but you're seeing here is, and then a total annual cost for this policy would be $3,300, almost, just under $3,400 a year. So that would be for a 53 and 50-year-old. Now let's take a look at a couple who've now waited 10 years. Now you're seeing 63 and 60, $150 a day, same multiplier, same benefit. So now you're seeing the cost is for the male is $2,214, where the female is $1,738. So it has jumped up considerably. Now you can get into the math and say, well, how much would I put into this policy versus how much would get? Now there's a lot of things to think about in there. One thing, what's the inflation rider? What does it cost? What's the inflation rider? How does it work? The other thing is, because you say, well, I can wait. I won't it to spend. But the trouble is, what if you end up walking with a cane? What if you have an accident? What if you get sick? And say at age 58, now you got a problem. So there's two things: cost of waiting you have to worry about, cost of the policy, plus what if you now cannot qualify. So the other thing I point out, because going back to what I was saying earlier, a lot of times I've had people say, well, I got enough money, I can cover it. Well, more high net worth people own policies than anybody, because they understand the leverage of this. They understand they don't want the rest of their assets eaten up by something like this. They just rather invest in the policy and let the policy handle this. So I think, to me, if this fits into your financial plan, or if you have the assets to cover this, this is just kind of a no-brainer. But I think even middle class, especially even upper middle class people, should really take a good look at this. But we're also going to show you a couple alternatives that we can do. Now, here's some alternative strategies. I've used all these, quite honestly, because when you're building a financial plan and trying to design income for people, trying to fit in the cost of a long-term care policy might be tough, right? And or that maybe they just don't want to spend that much money. So we look for alternatives, ways to do that. So there are many other things we can do. We use what's called linked products quite a bit. One of these are cash value life insurance policies with long-term care riders. Now, with the cash value life insurance policy, I look at it two ways, right? If it's a good, fully funded, max funded life insurance policy that's fairly mature, we've had it for 15 years, let's say 20 years, then I'm going to say maybe we don't necessarily worry about that rider. We use the cash values, if you understand how life insurance works and all that. But if you just got this policy and it's only 3 years old and you haven't got a lot of money in there, but you still got pretty good death benefit, because LTC riders, that's ultimately what you're doing, is you're using your own death benefit for long-term care. So that's how I sort of look at these. But they're to me, they're a great solution for especially middle-class America. I think it's a terrific solution. And even lower class people can, if you've set up their finances right, can take advantage of this. Then you have single premium life policies. Now, single premium life policies, I like a lot too. I'm very fond of those, because if you have assets that if you can build a financial plan and you're gonna have plenty of money to live the lifestyle you want, sometimes we can take $100,000 or whatever that number is, and you drop it in to that single life policy. Now, it's the nice thing about it is that it's done, right? So if there's not going to be any more payments. You don't have to worry about increasing in premium costs, anything like that. With both of these, I might add, with all these I'm going to show you, you don't have to worry about that anymore. And the other thing is, depending on the age, say you put $100,000 on one of these, you might end up with $400,000 with death benefit, but you can end up with $600,000 with long-term care dollars. Now, because they are truly structured more like a long-term care policy, it's just they're built on a life insurance chassis. They are designed to be a single premium. You can borrow money out of them and all that kind of stuff, but I typically I'm not worried about that with these, because that's not what they're best at, because single premium life loses a lot of the tax benefits, but being a long-term care policy, not so much. So this works really, really well, depending on the situation. Annuities with an LTC rider. Now, these will work too. I look at these sometimes if it makes sense to use this. It's probably the one of these three I use the absolute least, because one thing about long-term care riders, these other two allow you to get care in home. Most annuities out there, what they do is, say you're getting $1,000 a month out of your annuity, and you trigger a need for long-term care. You lose two of those ADLs. Well, there's going to be a surrender period too, and there's going to be a certain amount of time. But what will happen is that benefit will go from $1,000 to $2,000 a month. So it's usually a doubler effect is what we see mostly. But the other thing is, I'd say 99% of the policies out there, you have to get your care in a facility, and you typically have to wait 90 days, whatever the case may be, before that will actually trigger. So, they'll work. They'll be a big help. But will they be the whole answer? Hard to say. Just depends on what else you have. And I might add, how I use annuities, I'm using annuities for income quite often, or just safe. So to me, not all of them have this. So if it doesn't have it, but you still need the annuity, you can't flush the whole financial plan by trying to just get an LTC rider. So you have to kind of know the business, I guess. And then there's reverse mortgages. Now, I've used this, and I think this works really well too, because there's no cost. And the way reverse mortgages, especially if you're using an equity, and that's how this would work best with an equity line reverse mortgage. Because on equity line reverse mortgage, if you say do your reverse at age 65, that equity line is going to grow about 5 to 6% a year. And that's just the way reverse mortgages, FHA reverse mortgages work. And so if you have 200,000 or have an equity line of 200,000, let's say, when you did your reverse, you just do the math. It's going to grow at 5-6%. So you'll have quite a bit of an asset. So this could be a big help, because I will sometimes have somebody do a reverse mortgage, but we're not going to touch the money unless we absolutely have to tap into it, because we want that. We're going to let this bucket grow. You could use it for tax-free money later on, but you can also use it for reverse mortgage. For long-term care. So these are really good. Again, really good solutions for middle-class America. Really good. It's a good solution for anybody, really. But these are probably easier to swallow than paying that $3,000-4,000 for a long-term care policy. All right. How can you learn more about these? Well, if you want to learn more how we would handle long-term care in your financial plan, and really we've developed an online course. Now we do have coaching meetings or coaching calls, whichever you prefer. We do it online, we do it in person, whatever works. But all you have to do is go to surfcityfinancialaccelerator.com, apply for a free scholarship, and we will go through, because we believe in teaching and teaching our clients. So feel free, go to Surf City Financial Group, apply for that scholarship, and we can find out the best way to solve this potential problem for you. Thank you very much. Again, Brian Zeke, Surf City Financial Group, and look forward to talking to you in the future, maybe in that accelerated course. Thank you.